more on the markets and the financial sector. I want to bring in Bob Diamond, CEO of Atlas Merchant Capital, former CEO of Barclays, and our guru on all things Fed and finance these days. What would you do?
I think the Fed, listen, they waited too long. We know that. So we had raging inflation a year ago. I mean, I think it's about a year ago they began the rate rises, and it's now 4.5% to 4.75% in a year. And I think the Fed is reasonably pleased. My sense is we have, maybe 25 to 75 basis points to go, somewhere in that area, and then they'll pause and keep an eye on it. And I think inflation has peaked. It's definitely started to turn.
But turn to what, turn to what, 5%, to 3%, to 2%? Getting to 2%, is it going to be a project?
I don't think, if the Fed sees inflation in the 3 to 3.5% range, Andrew, I think they'll be cautious. They're not going to slam the brakes and say it has to get under 2%. So, I think we've seen the worst in terms of, the economic correction. I think 2023 is still going to be very challenging. The economy hasn't totally adjusted to 4.5%, 5% interest rates. But I do think that this is, the economy is still growing. And
the real economy of the markets, because you could say that the stock market is looking out, hopefully, 12, 18 months from now.
Yeah.
I can make an argument about that. Today, though, you talk to people in the shipping business even. They say, look, there's not nearly as many boxes coming off
any of the rate sensitive.
You know what I'm saying?
We wanted the economy to slow down. We needed to get interest rates up. I mean, was it a normal world for 14 years of zero interest rates? I mean, that was in essence, to feed the monster here. It was the public sector excess of zero interest rates for 14 years creates bad decisions. Right. And it also is a stimulus that we have to pay back for.
Wow, it's been really bad to get you to that point to say that. Wow, unbelievable.
But this is much more normal. You have a 10-year at 4%. There was 10 years leading up into COVID where it was between 1.5 and 3. A dip below 1.5 during the worst of COVID. But I think a more normalized interest rate environment, a little bit of volatility, a steeper curve, these things are all very, very positive for the economy in the medium to long term. Obviously, it's an adjustment right now.
But, Bob, every risk manager I know, they're not saying it's certainly happening, that we're going into some tailspin or some big downturn. But every risk manager I know who's lived through a lot of these things is taking precautions at this point. You've got Steve Schwarzman telling his companies to be your own bank. Don't need money for the next 18 to 24 months. Yeah. For 6 months, we've been hearing this from Jamie Dimon and other folks.
Well, what's wrong with that?
Yeah, but we don't know if it's likely to happen, but the odds are higher than that.
I mean, my sense is, the most recent one I lived through is post the financial crisis in 2009. It was like really deep, really dark, and fairly short, as it turned out. I don't think this is going to be deep and dark. I think we're seeing an economic correction. It's going to continue. One of the things we do like at Atlas Merchant Capital is the distressed business, which we started about 3 years ago. There's going to be some great opportunities in corporate stress because of bad decisions that were made, in such a long period of zero interest rates. But looking at the economy, I think this is going to be longer in terms of a correction, but much more mild than I think what the worst we're anticipating.
Would you rather have zero? I mean, zero inflation is definitely overrated. Nobody likes that. We saw that in.
Listen, we were hearing for 10 or 15 years the best thing that could happen is a little whiff of inflation. We got more than a little whiff.
How about people that have to have some fixed income or defined benefit plans or insurance companies or people that are retired living on fixed income? I mean, if you're at 3%, so what do they get? I mean, that's not an exorbitant yield you're going to see on the even on the long end. It's not the end of the world.
No, and I think this environment is. I actually think, as we said earlier, the Fed waited too long, and they helped probably raise inflation higher than we had wanted. But I've got to believe they're feeling reasonably good right now that they've got this thing back in a more normalized position. And I think from an economic point of view, the economy's not collapsing. And somewhat higher interest rates are pretty normal and good.
Can I ask you a banking question?
You may.
Which ones do you like? We were talking to David Solomon earlier this week. Goldman Sachs came out with its Investor Day. Big questions about the consumer business, though, to be honest with you, I think that's actually just a small portion of the story for them. I think the real story is what you think of their investment bank and the trading side of it. Well, which bank do you want to own these days?
So I would say two things. First, in terms of Goldman, I think the worries are way overdone. I mean, it's a
lot of noise.
It's a trading machine. It has been for decades, and there's a lot of things to worry about, but I'm not worried about Goldman Sachs right now. What I do see that is really interesting is what's happening in Europe, Andrew. And you and I have talked about this here, but from 2008 on, with the programs that the regulators put in the U.S. and the TARP program, the U.S. banks recovered quickly and very, very strongly. I mean, we had B of A and Citibank insolvent at the time, and they're both thriving, global banks today, very, very strong in the U.S. Europe didn't do that. It was kind of a biblical justice of the banks are bad, the bankers are bad, and it took a really, really long period. But if you listen to the investor day this week with Anna Botín and the new CEO, Hector, at Santander, it is, you look out at the next 3 years, 15 to 17% return on tangible equity, 50% of the profits going for buybacks and dividends, lower cost income ratio, they're not out acquiring things. It sounded like a U.S. bank.
Right.
And I think the other impact in Europe is the net interest income with higher rates goes much more to the bottom line in European and UK banks, where in the U.S. the banks, much more of that goes to the consumer.
Okay, so if you could own a bank
deposit
for the for the family,
yeah,
what bank would you own?
Santander.
That's your bank.
That's my bank. I think the price to book of the European banks versus the U.S., the valuations are so far off that doesn't,
Right.
that I think that over the next 2 to 3 years, that's the best buy.
And then finally, we also talked to Brian Armstrong this week from Coinbase. Mm-hmm. And you spent a lot of time thinking about stablecoins.
Yep.
Circle, obviously, was something you were looking at for the SPAC originally. What do you think happens? And right now, by the way, the Binance stablecoin has been sort of taken off the chessboard. What's happening here?
Crypto is a really, really broad term. But using in its broadest sense, I think a lot of the correction is done. We're probably much closer to the bottom. But boy, there were a bunch of things in crypto that I still to this day don't understand, that were very speculative, that let's hope they never, ever come back. On the other hand, there's things like Circle, which is USDC. It's a stable coin. It's payments. It's going to make payments between corporates cheaper and faster. It's good for the banking system. It's good for the economy. It operated within the U.S. regulatory perimeter. It had a very clean portfolio of U.S. Treasury, like T-bills. Those things are going to continue, and they still have 42.5 billion USDC outstanding. The business is doing quite well. Okay. So I think you have to separate it, Andrew, in terms of what was speculative and what's real in terms of financial services businesses for the future.
Okay. Bob, thank you. It's great to see you.
Good to see you.
Appreciate you being here.
Great to be in the studio.
Thanks.